Silver just pulled off the kind of V-shaped recovery that changes the entire mood of a market in a single day. Yesterday, we watched the metal hit the $84 area, then get punched in the face down into the low 70s. And today, silver didn't politely stabilize, it jumped back hard. A real, violent rebound, roughly $3 off the lows, dragging the conversation back to the one target everybody swore was dead. $80 is back on the table. And I'm going to tell you exactly what this move is, what it is not, and what you need to watch next, because a V-shaped recovery can mean two completely different things. The crash was a forced liquidation event, and the trend is still alive. The crash was the first crack, and this is the classic bounce that lures everyone back in before the next leg down. Most people can't tell the difference, and silver is the one market that punishes that confusion the hardest. Let's go. Why this V-shape matters. It's not just a bounce. Silver didn't drop yesterday because the universe changed its mind. Silver dropped because behavior changed. The market got hit by a perfect storm, profit-taking after a historic run, thin year-end liquidity, and the part nobody respects until it slaps them. Higher margin requirements, which basically means leveraged players suddenly needed more cash to hold the same positions. That is how you get a move that feels like a crash in hours. Not because everyone woke up bearish, because the system forced people to sell. So when you see silver bounce like this today, hard, fast, ugly, you don't call it bullish automatically. You call it what it really is, a stress test. It's the market asking one question. After the forced selling, is there still a real buyer underneath this thing? And today, we got an answer. Yes, there is. Reuters literally describes silver recovering after plunging from record highs, with spot silver up around the low-mid 74s today. Now, is that enough to declare victory? No. But it's enough to bring the $80 target back into the conversation. Because in a truly broken market, you don't get a clean snapback. You get drifting. You get dead air. You get nobody wants it. This didn't drift. This snapped. And snapbacks happen when shorts get nervous, dip buyers get aggressive, and the metal refuses to stay on the floor. That's V-shaped behavior. This is where most of the internet gets trapped. There are two worlds. World A, screen, world people watch the chart, they argue candles, they scream bubble or moon. World B, system, world people watch, margin rules, funding pressure spreads, physical premiums, and whether real supply tightness is getting worse. Yesterday was system world. Today is also system world. Because the reason we dropped so hard was not sentiment. It was forced behavior, profit-taking plus margin pressure in thin liquidity. And the reason we bounced is not hope. It's that buyers showed up immediately when the liquidation pressure eased. That tells you something. Silver isn't acting like a normal commodity anymore. It's acting like a crowded theater where one person yelled, "Fire." Everyone stampeded. And then half the crowd realized they still want a seat inside. That is not calm. That is not stable. That is a market in transition. What today's 335 really is, the mechanics. Now let's talk about the actual jump. When I say silver jumped about 3.35 today, I'm not saying it floated up gently like a balloon. I mean it did the silver thing. It hit the floor, and then it launched. That's what happens when yesterday's sellers weren't real sellers. They were forced sellers. There's a big difference between I don't want this asset and I need cash right now or I get liquidated. Yesterday's move was filled with that second category. So what happens the next day? Two things. One, the forced selling ends. Once the weakest hands are blown out, there's less automatic selling pressure. Two, shorts get a problem. Short sellers who celebrated the crash now face a new fear. What if that was the flush and now the trend resumes? So they cover. Dip buyers step in and you get the V. That's why this matters. Because if silver can bounce like this immediately after a brutal drop, it suggests the market still has a hunger problem. And hunger markets do not stay cheap for long. Why $80 is back and why it's not a meme. Now let's deal with the title part. $80 target is back. This isn't a magic number. It's a psychological gate. It's the line where headlines explode, retail piles and shorts start sweating again, and volatility gets nasty. We already saw silver hit record highs near the mid-80s and then get smashed down. So why does $80 matter now? Because $80 is the point where people stop asking, Is it bullish? And start asking, is this becoming an availability story? And that's the real theme. Silver in late 2025 isn't just being traded, it's being chased. The entire year has been explosive. Reuters notes silver's huge 2025 gain. So the market is not trying to discover a fair value. The market is trying to figure out how violent the repricing has to be before supply and demand can breathe again. That's why $80 keeps coming back like a ghost. The trap. Why V-shapes can destroy both sides. Now listen carefully. A V-shape recovery is dangerous for bulls and bears. Bears get trapped because they short the crash. They feel smart. Then price snaps back so fast they can't exit clean. Bulls get trapped because they buy the bounce with leverage. They feel like geniuses. Then silver does a second flush and wipes out the late buyers. Silver loves the double tap. It loves the move where it says, okay, you survived the first drop? Cool. Here's the second one. So the question isn't, is today bullish? The question is today the start of a real recovery sequence? Or just the first bounce in a longer unwind? And we can answer that, without guessing, by watching a few specific signals. The 3 checkpoints that tell you what game you're in, here's what I'm watching next. No drama, just checkpoints. Checkpoint 1, can silver hold the reclaim zone? Silver bounced into the mid-74s today, according to Reuters. Cool. Now the test is simple. Does it hold above the bounce zone, or does it fade back and bleed? A real recovery holds ground. A dead cat bounce gives it back slowly. Checkpoint 2. Does the market stop acting thin? Yesterday's crash was amplified by thin year-end conditions and risk controls. If liquidity stays thin, you can get random wicks. But if the market starts acting thicker again, less crazy, more steady, then it's a sign the panic phase is passing. Checkpoint 3. Does $80 get challenged again without collapsing? This is the boss level. If silver climbs back toward $80, the question becomes, does it slam into a ceiling and get rejected violently? Or does it grind, absorb, and push? A controlled push says demand is real. A violent rejection says leverage is still too crowded. What caused yesterday's crash, so you don't misread today? Let's put yesterday in one sentence. Yesterday was a liquidation day, not a silver is dead day. It was triggered by profit-taking after a massive run-thin liquidity and higher margin requirements pressuring leveraged positions. That is why you can't treat yesterday like a normal trend reversal, because trend reversals usually come with distribution time, multiple failures, fading momentum. Yesterday was not time. Yesterday was force, and force can reverse quickly when the pressure releases. That's how you get V-shapes. The Western mistake, confusing volatility with failure. The West loves one story. If it drops hard, it must be over. That's a stock market brain. Commodities, especially silver, don't behave like that. Silver doesn't end trends politely. It whipsaws them. It terrifies people out. It creates these I'm never trading this again moments, and then it rips again. So if you're watching this and thinking, okay, so $80 is guaranteed now. No, nothing is guaranteed. But if you're watching this and thinking, okay, so the rally is over because it crashed once. Also, no. The only clean answer is we are in a regime where silver is acting like a crowded trade with tight supply narratives and leveraged pressure. And in that regime, V-shaped recoveries are common because panic drops create discounts and discounts create hunters. Here's what most people don't want to accept. Silver isn't trying to be fair right now. It's trying to find the price where demand cools, leverage clears, and the system can breathe. Yesterday was the system clearing leverage. Today is the market testing whether there's real demand left underneath. And if that demand persists, $80 comes back. Not because of hype, because there's no time for softness when a market is being pulled between profit-taking margin rules and buyers who treat dips like opportunity. This is not financial advice. This is how to not get emotionally farmed. If you're trading, respect volatility like it's a weapon. Don't use tight stops in a market that wicks for sport. Don't assume one day defines the trend. Watch the recovery behavior, not your feelings. If you're holding, your job isn't to worship $80. Your job is to watch whether dips keep getting bought aggressively, because repeated aggressive dip buying is what keeps the trend alive. Let me end with the line that matters. Markets don't break because the chart looks scary. Markets break when force behavior becomes normal. Yesterday was force behavior. Today was the rebound from that force. Now we watch what happens next. Because if silver can keep recovering while the system is still adjusting, then $80 isn't a fantasy. It's a pressure point. And pressure points in silver don't get resolved quietly. They get resolved violently. If you want part 2, where I map the next pressure shelves and the exact signals that confirm whether this is a true recovery sequence or a dead cat setup, comment V-shape. And tell me one thing. Do you think yesterday was the flush or the first crack? Because the next move will expose who's trapped, and in silver, someone is always trapped.